For some people, it would be way more than enough, and for other people, it would not be anywhere close to enough.
Next, our question is from Russell in Benton. I'm 67 and will have $6,000 a month in retirement income. The bulk of my $3 million is in stocks. I'm not sure how to adjust my investments before I retire next year. What should I do? Russell, thanks for the questions. Good solid $6,000 a month in retirement income. What we don't know is what are the sources of that. We're not sure from the question, Janet, whether the $6,000 or a portion of that $6,000 a month is coming from the stocks, coming from the dividends off the stocks, or if he's saying he already has $6,000 in guaranteed income. So we need to look at that. What sources of guaranteed income do you have, and is that enough to pay your expenses?
So the things that we would put into that guaranteed income category are pension and Social Security. Normally when people are coming to us at the beginning of their planning stage, they don't have any other guaranteed income source like an annuity. So we're going to look at that pension and Social Security if you have one or both of those and determine what that total is, and then if there's a gap. So you've talked about that you would have $6,000 a month in retirement income. Is that pre or post tax, and is that enough? And for some people, it would be way more than enough, and for other people, it would not be anywhere close to enough. So there's not like a right or wrong answer on it's enough. It is, what is your answer? What do your expenses look like in retirement? So it's very important to determine what you have going on as far as the required income coming from guaranteed income sources. And then, Scott, you were talking about that $3 million in stocks. There's a lot of ways that could look.
Right. Yeah, that's a big question I have, is when he says, is it in stocks, is it in individual stocks, or are they in stock funds? Because that would be a major point of emphasis here for me to talk about. If they are in individual stocks, I would certainly think at 67 that it is time to adjust your investment strategy. Now, if we do that income planning and that $6,000 a month is coming in from other sources, and that's all you want and that's all you need in retirement, then you really are looking at a purpose for this $3 million that is not immediate. So growth is not something we would tell you to back away from by any means, but concentration in individual stocks with $3 million would be a pause for us.
It absolutely would be, but I'll add a pause to that as far as just doing anything immediately. If you've got $3 million in individual stocks, my next question is how much of that is gains?
Right.
And
where is it? Is it non-retirement or retirement money?
Exactly. Yeah. And so if it's in retirement accounts, then you have some choices, and you don't have to worry about capital gains taxes on that. You can liquidate inside of the IRA shelter and buy something else, and you're not realizing those gains in terms of having to pay taxes. You are realizing gains, but it's not going to give you a taxable impact. But if you have this in some non-qualified assets, and those are, you've got any significant gains there, then that is a significant possibility as far as your taxes are concerned. And you can offset, and many times, Scott, we've seen this when people will come in with a statement and they're like, well, this one is up $500,000, but we look across everything else and maybe there's $400,000 in losses over time in some of the other things. So it's offset. So you can wash the net impact between the gains and the losses and lower your tax impact on that. But I just want to, I kind of rambled on that a little bit, but I want to give you some caution about just pulling the trigger and saying they said I didn't need to have $3 million in stocks. Be cautious about how you do that.
Yeah, absolutely. And I think the other piece to this too is if it isn't a non-retirement account and you're not really planning to use this during your lifetime,
yes,
and it's a legacy piece, it's going to be passed on, you have a great opportunity to do that in a very tax-efficient way. This has become really more into clearer view with the inherited IRA rule. It used to be that was a pretty tax-efficient way to pass money on, but it's not anymore because the next generation inheriting those IRAs has to pull it out by law over a 10-year time frame, which can create a huge tax bomb for the next generation. But a non-retirement account with huge gains that haven't been realized can be passed on to the next generation, and they receive a step up in cost basis. So let me explain what that means. Let's say at 67, Russell bought some of these stocks a long time ago, and if he bought it at $10 a share and now it's worth $50 a share, if he were to sell it in his lifetime, there would be a $40 per share capital gain, right? There would be gains that he would have to pay taxes on. But if he passed away with that price of $50 per share, his inherited money would actually receive a step up to the $50 per share cost. So we would bypass that $40 of gains, Janet, and receive if they sold it that day, right, the day after the death, and there was no more step up from $50, they would not actually, it would not be a taxable event.
So all of that to say, I think we have more questions than answers, but but when we can get answers to our questions, then we can answer yours at the end of the day. So I think it comes back to the need for an individualized plan, that we have a big picture, but the details on your individualized retirement income plan really matter.